We're going to talk about the two words that tell us when junior mining stocks are going to ignite. Anybody want to take a stab at what those two words are? What are the two words that tell us, juniors are going to take off? What do you think? Quantitative easing. That could be one, absolutely. Yeah. All right. And then we'll see if this rapper Gold Digger shows up. I don't know. We'll see here. Okay, so the setup for the junior market to take off is in place, in my opinion. And here's why. There are multiple positive shifts taking place in the background right now that not a lot of people are aware of, but signal that interest is definitely growing in our sector and the setup is in place. I think there's a new M&A cycle that is imminent. I also am going to show you the biggest gains in stocks. I'm just going to go by history and show you. I'm not going to give any projections or anything to show you what's happened in the past and even recently in the bear market. The two words that tell us when juniors will ignite: multiple potential catalysts, all right? The first thing I want to point out is that big money interest is growing in our tiny little sector behind the scenes. Did you know, there in the orange, 2024 was the second highest amount of capital raised in the last 9 years. There were over 1,000 deals in our tiny little sector in 2024. And then in the green, almost $1.4 billion was raised between December 7th and January 15th. So what is significant about that 5-week period of time? It was Christmas, it was the holidays. So while everybody's Christmas shopping, big money was coming into our sector. $1.4 billion in that 5-week period over the holidays. The next, Citadel put an $8 million call spread on GDX. Michael Burry, you know that name from The Big Short fame, right? He is posting very positive, bullish threads on X about gold. Long threads about how he's positive on gold. The second thing I want to show you is that the earnings and free cash flow of the 6 largest gold producers jumped last quarter due primarily to the higher gold price. So look at that. There's the 6 companies. That first column is earnings in Q4 2023. The blue column is earnings in Q4 2024. And the green column is the percent change. So the percent change you see is triple digits from the producers from 1 year to the next. Now, there was a little bit of M&A going on with some of these companies, but the primary reason, the primary catalyst was the higher gold price. Next column over, free cash flow. Many analysts say free cash flow is a more honest appraisal of a company's corporate health than earnings, because you can play with earnings a little bit, right? Free cash flow Q4 2023, free cash flow Q4 2024. Look at the percent change there, the far right in that green column. The increase every single one of those companies had in free cash flow from 1 year to the next. Despite a little M&A, it was primarily because of the higher gold price. These guys are swimming in cash. Now, some of you are going to point out, well, Jeff, costs are rising. Yes, they are. Costs are rising. You can see from the end of 2018 there to where we are now in the blue bars, $1,451 per ounce all-in sustaining costs is the industry average right now. Costs have gone up over 50% in 5 years. But look at the gold line. The gold price has risen more than costs. Costs are up 50%. The gold price is up 140%. Think about the significance of that. In a high inflationary environment, margins for gold producers are rising more than costs. Margins are increasing. These guys are just printing cash right now. This is one reason I think there's another cycle of M&A that's going to come along. Miners have more cash and less debt. This is net debt to EBITDA. You can see 25 and 26 there on the far right. They're projecting, as a group, no net debt for these companies. The significance of this is these guys are swimming in cash, they're generating a lot of cash, and they have no debt. This is a perfect setup for an M&A cycle. Many of us wonder, well, why aren't these seniors buying the producers? They could buy 5 of them for what they could buy one for 5 years ago. Now they have the cash. Now they have low debt. They're ripe to begin an M&A cycle. And there's the 2 words, ladies and gentlemen, 2 words that tell us when juniors will ignite: sector rotation, in my opinion. Sector rotation is simply financial assets moving from one class to another, investors moving from one to another. And it's not really happened for the juniors yet, because during periods of crisis, when there's geopolitical conflicts and threats of inflation, threats of tariffs, people don't go out and buy junior stocks, they buy gold, okay? So it hasn't really happened yet, but I think it's going to come. Some stocks have been doing well, despite there being no real sector rotation yet. But clearly, most companies are going to do better when there is. In my opinion, sector rotation is likely when one or more of these markets go weak. First of all, here's the NASDAQ. This is the gold to NASDAQ ratio. We all know that gold has made 8 consecutive weekly all-time high closes until this past week, but the gold price has really ignited and taken off. But when you compare it to the NASDAQ, the gold price has gone nowhere for 5 years. We need to see a sector rotation out of the NASDAQ into the gold market. This is the gold to Bitcoin ratio the last 5 years. Again, despite the rise in the gold price, gold has gone nowhere for 5 years relative to Bitcoin. So all the investors that are playing over in crypto need to come over to the gold sector. This is the gold stock. This is the HUI, the gold stock index, relative to the S&P 500. You can see the highs and lows are marked there. There's the current ratio on the far right. Relative to the S&P 500, gold stocks have gone nowhere. This ratio would have to rise 10 times just to match where it was in 2011. Okay, so a combination of the S&P coming down and gold stocks going up. Okay, this is a fun part here. I want to give you some examples of what has happened in the past with junior mining stocks, the kinds of gains we've seen. This is a great chart from Joe and Brent over at Exploration Insights. At the top there were 141 10-baggers from 2008 to 2011, that very last bull market that we had. 141. So if there's 2,500 mining stocks out there that we could potentially look at, that's roughly 5%. These are companies that went 10x or more. Many of these companies went more than 10x, 141. So we always hear, well, Jeff, only 1 out of 3,000 projects ever becomes a mine. That's true. But many stocks have big gains before they get there, even if they don't get there. Okay, I'm excited to show you this because I bet you haven't seen this before. These are the biggest stock gains each year. The bars show the gains for the stocks, but the green part of the bar is the range of what the top 6 performing junior stocks did in each of those years. So in 2020, the top 6 ranged from a 900% gain to a 1,344% gain. 2021, 562 to over 1,500%. 2022, 191 to, almost 1,200%. 2023, 378% to over 1,700% gain. And last year, 354% to over 3,100% gain. That's what the top 6 did. Now, we as investors are not always going to get the top 6. But I mean, these 5 will be in the top 6 though, right? Right, yeah, okay, good to know, good to know. But what if you could just get one of those a year? What if you just get one of them? If we screen properly and go after best of best with the best potential, I think we could do that. I saw Berkshire Hathaway's report last quarter. It just came out. They had a whopping $343 billion in cash. So I thought, what does that look like compared to gold companies? These are the top 8 gold producers, and this is not their cash level. This is their market cap. This is not even an apples-to-apples comparison. But Berkshire Hathaway could buy every single share of every one of those 8 companies and still have $143 billion in cash left. Now, Berkshire Hathaway is not going to do that. My point is, consider just how much cash is on the sideline before the sector rotation begins, okay, that could come into our tiny little sector and just blow it up. Okay, what triggers a capital rotation? We could talk about this for an hour. There's many potential things. Here's a few that I think could be it. This is inflation. This is the CPI. The dark bar is the CPI from the 1970s. The gold bar is our current CPI, what it's been doing in the US. Look how similar the pattern is. So do we get another hike? And you can see the gold bar, the gold line just turned up again here the past few months. Do we get another big spike like we did back in the 70s? If we do, look out. What about money printing? There's your quantitative easing, sir. What if they really ramp up the money printing again? This is from Tavi Costa at Crescott Capital, the gold to money supply. Is it about to break out of a 45-year downturn? If it does, wow, look out. There's going to be a lot of money coming into the system. What if China wants to increase its reserves? The blue bars are the gold as a percent of reserves for each of those countries, okay? Look way over to the far right in the red bar, China. China, as a percent of their reserves, what they hold in gold is very small. It's only 2.5% roughly. So what if they want to increase it? What if they want to go to just 10%? To go to 10% of their reserves in gold, they would have to buy twice as much gold as they already own right now on the books. Twice as much. That would still be below what 15 other countries have as a percent of their reserves. That would be explosive. Did you know Beijing just announced that insurance companies can now buy gold? Insurance companies have to be very conservative, right? But the government is now allowing them to up to 1% of their assets in gold. 1% of their assets at $2,800 gold is over 7% of last year's gold production. This is one sector within one country, okay? I don't know that that's going to happen, but it's now allowed. We'll probably see them starting to buy more gold. What if there's a technical breakout, okay? That would bring in a lot of momentum chasers, right? This is the GDXJ, the Junior Miners Index. You can see the all-time high there on the left. You can see the breakout from the golden triangle there, or the green triangle. But I want to read the white insert there. A simple return to the 2010 high of $179 would equate to over a 300% return just in this ETF. And that's just if we match where it went in 2011. So if we're on the cusp of another bull market, and I believe that we are, then we're going to see a lot of investor interest come in. We're going to see a lot of demand. We're going to see a lot of buying. We're going to see a lot of momentum chasers, and they're going to drive up the price. So at some point, I think that happens. So, ladies and gentlemen, sector rotation could be the key. We don't know when. We don't know the catalyst. But I think we should begin to build our positions now. And to help us while we wait for sector rotation, ladies and gentlemen, I would like to introduce you to, there we go. Ladies and gentlemen, rapper Gold Digger. You're gonna rap along with me, okay? You ready? Here we go. All right, maybe a little higher. Well, Where is our sector rotation? We feel forsaken. We are uncertain, living in confusion, waiting for the transition. Don't be heartbroken. There is a solution, and it is on the horizon. So give me your attention. You don't need no aspirin because I got your medicine. Don't be mistaken. There ain't no deception. Whoops. We will see redemption. So here's my suggestion. Build your position now and wait for sector rotation. Juniors will get attention. They'll get a big injection. We'll see lots of money and a big explosion. Inflation, stagflation, recession. I am unshaken because I got the prescription for monetary salvation. Sector rotation will make me a quadrillion and I will be like Led Zeppelin. I will go on vacation and meet a sexy French woman. Yeah. So join me for the duration. You will see elation. Now give me an ovation and buy a subscription! Thank you, ladies and gentlemen. Go Digger out! Yeah.